Welcome to the Valuation Master Class case study. This is where you'll learn about interesting stocks and how to value them. What's interesting about Sumitomo is that it trades at a price-to-book multiple of 0.8 times. Now, this is Andrew Stotz of the Valuation Master Class. Let's get started. Remember, this information is for learning purposes only. It's not investment advice or a recommendation. Sumitomo Heavy Industries Limited is the company we're talking about today. It's a Japanese heavy equipment manufacturer and part of the 400-year-old Sumitomo conglomerate. Now, the question is, can management's commitment return Sumitomo's stock to previous heights? There's three things to know about this company. First, gearing up in M&A activity to drive the top line growth. Second thing is growing CAPEX lays foundation for organic growth. And the third is management's focus on ROIC should enhance returns. Let's look at some key statistics. First, there's 7 analysts covering this company, and the price of the company is Japanese yen 3,500. That's a target price and an upside of 19%. Analysts have it as a buy. Price to book is 0.8, as we mentioned before, and dividend yield is about 2.1%. My estimated value is 3,647. That's a 24% upside, and in that case, it would be a buy. So let's look at sales. The revenue breakdown of this company is logistics and construction, 36%, energy and lifelines, 24%, industrial machinery, 24%, and mechatronics, 16%. So basically about 50% of its revenue is coming out of Japan, 14% out of the US, and 11% out of Asia, excluding China, and another 11% out of China, 9% out of Europe. So the price is still bearish. Volume signals are somewhat unclear. Overall, the stock price has performed poorly over the past 6 months, down about 26%. But since third quarter 2021, the 200-day moving average stayed above the 50-day moving average, which indicates a bearish signal. However, since early 2022, the share price has seen a strong rebound and should push upwards, and possible that the 50-day moving average could cross the 200. And throughout the whole period, the RSI has fluctuated around the 50% mark. Not a lot of signal there. The recent share price run is interesting to me, and I want to look in more into the story of this company. First of all, gearing up in M&A activity to drive top-line growth. You can see the most recent acquisitions. The company in 2017 acquired Sumitomo SHIFW for 23 billion Japanese yen. Then they also bought Persimmon, that for 4 billion Japanese yen. In 2018, they bought Lefert for 22 billion Japanese yen. In 2019, they bought Invertech Drives for 15 billion Japanese yen. Sumitomo's management has a strong commitment to continuous growth. M&A has been a useful tool to expand the business. And for the next 3 years, the company has allocated about 40 billion Japanese yen for acquisition purposes. This roughly equals about 20% of the total budget available for CAPEX, R&D, and M&A. I expect the company to pursue 2 to 3 acquisitions of similar size as recent transactions. Number 2, the story is growing CAPEX lays foundation for organic growth. Now, I'm showing a chart here that shows the CAPEX in the green line, and we can see that CAPEX is growing from Japanese yen 20 billion in 2017 all the way up to our expectation of about 45 billion in 2022. Now, also depreciation is lower than that. In other words, CAPEX is above depreciation. And I've done a ratio of the CAPEX relative to depreciation ratio. And here, what we can see, and that is the bar in the chart. If you see it, if you're listening, basically there's a bar, and that bar has been above 1 consistently, which means CAPEX has been higher than depreciation. So With an average CAPEX to depreciation ratio of 1.3, the company is still in an expansion stage. Capital investments and R&D expenses are likely to further increase, adding capacity to realize revenue growth. And the R&D budget for the next 3 years accumulates to about 70 billion Japanese yen, which is a 40% increase to the past 3 years. So they really are committing to it. Now, let's take a moment and talk about the CAPEX to depreciation ratio. It's not a typical ratio that you see in a textbook, but it's a ratio that I use a lot in the Valuation Master Class and in my own valuations. Typically, if you look at a growth firm, the CAPEX should be more than the annual depreciation charge, maybe 150% of it. Why should CAPEX be more than depreciation? Because depreciation basically tells you it's an accounting estimate of how much deterioration there is with the assets that are in place, the historic assets. And basically, if a company only has CAPEX that matches depreciation, it means it's only spending enough to keep the existing assets up and running at the same pace. So having more than 100% of your depreciation charge in CAPEX means you're growing. Now, very high growth firms could have their CAPEX at 150% of depreciation or more. In fact, they could have it much, much more. Remember also that CAPEX is lumpy. Depreciation is pretty consistent. So a lumpy number relative to a consistent number, you have to be careful about. And low or no growth firms, CAPEX is about equal to the annual depreciation charge. So this gives you a little guide that you can use CAPEX to depreciation ratio as a little tool to keep yourself in check in your forecasts. So choose CAPEX assumptions carefully, as it has a huge impact on your estimate of value. Why does it have a huge impact on your estimate of value? Because free cash flow is the cash flow available after CAPEX. So if your CAPEX is super high, then your free cash flows are going to be very low. Now, that may be the case, but you just want to make sure you don't make a mistake in that. To look at an example here, I've got a chart that I'm showing, which shows what I will call a reasonable case. That's the case that we have right now of about 1.3, meaning CAPEX is about 30% higher than depreciation. Now, if we were to overestimate CAPEX and raise that ratio to 1.75, what we would find is that the EPS of the company, or the value per share, would fall by about 8% because of the CAPEX need that they have. Now, if we underestimate CAPEX and we just keep it at the level of depreciation, we're going to see that the value of the company goes to 3,803. That's about 4% over our base case at a ratio of 1.3. The point being is that you can manipulate the free cash flow to the firm quite substantially by the CAPEX. So make sure you're very careful about what you're doing there. Now, point number 3 is management's focus on ROIC should enhance returns. What we're seeing, I'm looking at a chart right now, and it shows the ROIC, which has ranged from between 5% and about 10 or 11% for Sumitomo. And also the dividend yield has ranged from about 2 to 4%. Now, the recovery of the ROIC is one of the management's top priorities. It aims to get back to 8.5 ROIC in 2023, which is basically a realistic forecast in my perspective. The company's focused on a constant payout ratio of about 30% of dividend, and they even paid dividends during the 2020 crash. Now, enhanced profit prospects could lead to a juicy dividend yield of 3.3% and 4.2% in 2023. Now, remember, you can scan this QR code to go to the valuationmasterclass.com blog to download all free case study reports for free. Also, if you're listening to this on the podcast, basically, you can go to the show notes or go to valuationmasterclass.com blog and get the information. Now, let's go through the FVMR scorecard. It measures a stock's attractiveness relative to all other companies. Attractiveness is based on 4 elements: fundamentals, valuation, momentum, and risk. The scale is 1, best, to 10, worst. So the company's not really that sexy right now, I would say. On many measures, it's closer to worst than it is to best. Valuation is where it does have a little bit of a standout. So let's look at that for a moment. And here we can see price to sales at about 0.4. That's very, very low. Price to earnings at about 8.5 in the past 12 months, and price to book of about 0.6 to 0.8. It's been a while since this company traded above book value. So this is why I say there is some attractiveness in the valuation of this company. Now, recently I created a short online course explaining my FVMR investing approach. I usually sell it for $97, but for a limited time, I'm offering it for free. You can just scan that QR code and enter. Now, let's look at the forecast. Right now, most analysts still have a hold, but some see upside. So there's 7 analysts covering the company. Their upside is about 19%. 3 analysts issued a buy recommendation while 4 stay as a hold. Now, consensus expects 2 strong years in terms of revenue growth, but then 0 growth in 2023. Now, this is an interesting case, and I would highlight it, particularly when you're valuing a company, that sometimes the visibility of what the company's going to spend on or what the revenue is going to be a couple of years out is very low. And so what happens is that sometimes people just say, well, I'm just going to assume 0 because I don't know what it's going to be. But the truth is, as an analyst and in any valuation, reverting to 0 is not an acceptable method of doing it. You've got to make an estimate of what you think that they're going to grow by. It could be 1%, 2%, 5%, but you've got to put in something beyond 0. And I suspect that what's happening here with analysts is that they are basically not sure about what the CAPEX is going to be in 2023. And so as a result, what they're doing is just putting in 0. So I think the company's strong commitment to growth could lead to a positive surprise in 2023 relative to what analysts are saying. Now, let's just look at it a little bit more detail. I just want to welcome everybody to the show and to the podcast and to the YouTube and LinkedIn. I see Hillary there. Good to see you, Hillary. And all the others, Lee's there, Yates, Ramsey's there. Thank you. So let's take a look at the P&L here. The profit and loss statement, well, Sumitomo has a strong ability to drive growth organically and through M&A. And so I'm forecasting relatively strong growth. Also, its product portfolio is well equipped to ride the demand rebound. It really is a heavy industry business. And here we can see, I'm looking at the assets of the balance sheets, and I can see that Sumitomo has high working capital requirements. More than 40% of its total assets are either accounts receivable or inventories. This company has a huge amount of short-term cash demands. So when you're calculating the free cash flow of the firm, you got to be careful about your CAPEX, but you also have to be careful about your working capital. And here, in this case, you got to be super careful because that working capital is a pretty large number. What about liabilities? If I look at the balance sheet, I look at long-term debt, it's tripled between 2019 and 2021. I expect the company to slowly repay its debt given its strong cash flow and cash generating ability. And feel free, if you've got any questions as I go through this, that you can take a note and send it in. I see Akilesh, nice to see you. And let's continue on and let's look at some ratios. The revenue has been resilient through the pandemic. It's been down about 4% in 2020, about 2% in 2021. So it is an industrial company, and that tends to fall a bit. It's not like a consumer staples company or healthcare where it tends to be very stable. The company only recorded a drop of 4%, as I said, in 2020. Now, if we look at ratios here, we can see the company has low leverage and could turn net cash in the future. In fact, its net debt to equity is basically 0. In other words, the total amount of debt that the company has is equivalent to the amount of cash that the company has. I always use net debt to equity because of the fact that I know that a company, if I was to acquire a company, let's just say we bought the whole company and we wanted to retire the debt of the company, we could use all the assets of the company to retire that debt in this particular case. Now, let's go through valuation. First, I want to look at this concept of, what's the long-term share price performance potential? Could this be a 5-bagger, a 10-bagger? Let's look at it. First way of looking at potential is to try to understand price times quantity. That's the revenue. And I would say that the price potential is moderate. There's certain specialized equipment that they could charge a premium on or that they could increase the prices on. The quantity is, I would say, there's a moderate potential for growth. Capital investments and M&A activities are driving growth. And if they have good activities, that could bring it. So I'm kind of moderate on the two. Cost of goods sold, well, the input prices can fluctuate a lot. It's difficult to control that. So I would say there's kind of weak potential that they're going to be able to increase their gross profit margin. And the operating margin or operating expenses, the SG&A is expected to rise in line with expansion. We don't have any indication from the company that they're going to start to cut their operating costs or expand their marketing costs. So I would say there's weak chance. So if I look at it from an earnings perspective, I don't think this company is going to go up 20% per year or anything like that. So I don't think there's a potential for this company to go up by, let's say, 5 times for the share price when it comes to earnings. But let's look at price, because on a valuation basis, maybe it does. So if we look at PE, I would say the potential is good. It's cheap on 2022 earnings at about 10 times, and it's got slightly higher EPS growth. As far as price to book's concerned, it's trading on about 0.6, 0.7, 0.8, and that's much cheaper than the industrials in Japan. And right now they have a slightly weaker ROE, but I think that's going to be rising. So I would say from an earnings perspective, not a huge potential, but from a price perspective, I see some potential. So re-rating to country average provides some significant upside. Let's look at free cash flow to the firm. The cash flow should return to positive from 2022 onward. And in fact, cash flow is positive in 2021, in fact. Now let's look at my value estimate. First of all, I'm a bit more optimistic about the growth outlook. Both M&A and organic expansion should pay off in terms of revenue. So my revenue forecast is 5.2 versus consensus of about 4.4. Gross margin, I'm going to keep about the same as consensus, and same with net margin. So really, it's a little bit higher growth than consensus. Sumitomo's margin has been pretty stable over time, and therefore, there's no reason to deviate significantly in the assumptions. Now, I'm using the free cash for the firm method, a cost of equity of 10.5, which you could argue in Japan is actually a little bit high, but let's use 10.5. That gives us a weighted average cost of capital of about 8.2, and we're using a terminal growth of about 2. The result of that is we get an upside of about 24%, a base case of 3,647, and the bull case, I can come up with about 3,800, which is a 29% upside. In the bear case, about 3,507 Japanese yen for a value, and the upside for that case would be about 19%. So it's not bad from what I see right there. Now, let's look at the company's world-class benchmarking scorecard. We identify a company's competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth. I scale it from 1, which is best, to 10, which is worst. If I look at Sumitomo benchmarked against 1,480 large industrial companies worldwide, it's slightly below average at about a 6. This is, what I would say kind of an average company relative to the industry. Now, if we look at profitability, also profitability, mainly ROA, is about a 6 in the past 12 months relative to average of about a 5. So it's below average on its profitability, and its growth is slightly below average too. So management really has a job to do to start to pick up either profitability and growth to drive some share price performance. And if that started to happen, I think we could get more share price performance. So what are the risks? The key risk is falling behind competitors and capturing this rebound. Acquisitions could drag margins when integration takes time, and potential overinvestment in capital-intensive industry could be harmful. And the environmental pressure to develop sustainable machineries requires R&D, very high. So what's the conclusion? What's your conclusion? Well, let's look at my conclusion. The past has shown management's commitment to growth and enhancing ROIC. They're trying to do it, and I think they got a chance to be able to do it. Valuation appears cheap. Could be a good opportunity to buy. And it's an attractive dividend yield, and it's adding additional returns. So my question to you is, can management's commitment return Sumitomo's stock to previous heights? That's what I would like you to answer in the comments. And my name is Andrew Stotz, and this is the Valuation Masterclass case study. I'll see you in the class.